Have you ever wondered how banks calculate your debt capacity? It all comes down to a simple but powerful number, your debt-to-income ratio, or DTI. Think of your monthly income as a big cake. The DTI is the slice of that cake you'll need to set aside every month just to pay off your debts. The bigger the slice, the less you have left for everything else. So why does this number matter so much? For banks, the DTI is a quick way to measure risk. If your DTI is low, it means you have plenty of room in your budget to handle new payments. But if your DTI is high, it signals that you might struggle to keep up if something unexpected happens, like losing your job or facing a sudden expense. For you, knowing your DTI helps you understand personal budget limits, making sure you still have money for essentials, fun, and savings. The formula for DTI is the same almost everywhere. Take your total monthly debt payments, divide by your monthly income, and multiply by 100 to get a percentage. But what counts as income and debt can vary. For debts, banks include everything with a monthly payment: mortgages, car loans, personal loans, credit cards, and even legal obligations like maintenance. For credit cards, they usually count the minimum required payment, not what you actually paid last month, or prudently, the percentage of the current outstanding balance, typically between 3% and 5%. Now here's where things get interesting. In most European countries, banks use your net income, the money you actually take home after taxes and deductions. This gives a more realistic picture of what you can really afford. Limits can vary, but often your DTI shouldn't go above 33% to 50% of your net income. In the United States, though, banks usually use your gross income, your salary before taxes. This makes the calculation simpler, but it can make your DTI look lower than it really is, since you don't actually get to spend your full gross income. That's why US DTI limits are usually set lower, often between 36% and 43%. Another key difference is the stress test. In Europe and Canada, banks often check if you could still afford your payments if interest rates suddenly went up. This helps protect both you and the bank from future surprises. In the US, stress tests are less common, with more focus on your credit score and the value of your home. So, what's the takeaway? The DTI is more than just a number. It's a tool to help you and your bank make informed decisions about borrowing. Aim to keep your DTI as low as possible, ideally below 30 or 33%. That way, you'll have peace of mind knowing your finances can handle whatever life throws your way. And if you want to see how a new loan would affect your DTI, try out our educational spreadsheet to simulate different financial scenarios, which even includes a built-in stress test to help you plan ahead.